Let's talk about the number that can derail an entire week. It's not an audit notice, it's not a certified letter, it's not even a phone call. It's the line at the bottom of your tax return that says amount you owe. That number hits differently. It doesn't matter if it's 2,300 or 23,000. It lands in your chest the same way. Your stomach drops, your brain starts calculating, your internal dialogue shifts from I had a great year to what did I do wrong? Somewhere along the way, we decided that owing the IRS money means something about you. That if you owe, you must have been irresponsible, greedy, careless, bad at math, or bad at business. And because of that narrative, something dangerous happens. You stop opening the mail. You stop logging into irs.gov. You avoid your tax software. You tell yourself, I'll deal with it later. And later quietly turns into penalties. Here's the zero fluff truth. Owing the IRS is not a moral failure. It's a math outcome. It's a reconciliation problem. It's the difference between what was paid in and what was owed. That's it. The IRS does not attach emotion to that number. They do not evaluate your character. They do not evaluate your intentions. They evaluate the ledger. Taxes are reconciliation. Income came in, payments went out. The difference is the balance due. Now here's the part most business owners don't realize. Owing money often means you were profitable. Let me say that again. Owing money often means you made money. And that's the goal, because quarterly estimates are projections, not crystal balls. Sometimes the projection misses. Sometimes revenue spikes in quarter 4. Sometimes a client pays late and pushes income into a different quarter. Sometimes you drop a W-2 job and lose withholding mid-year. Sometimes a credit you qualified for last year disappears. None of those scenarios are ethical failures. They're variable inputs, yet the brain doesn't process it that way. The brain processes a bill from the government as danger, and when the brain senses danger, it defaults to one of 3 responses: fight, freeze, or avoid. Most people choose avoid. Avoid the envelope, avoid the phone call, avoid the login screen. And here's where it becomes expensive. Because the IRS is not emotional, it is procedural. When you ignore the bill, the system keeps moving. Interest accrues, notices generate, automation continues. Silence does not pause the machine, participation does. That's what this episode is about, participation. By the end of today's episode, you are going to understand why owing happens in extremely ordinary ways, why not filing is dramatically worse than not paying, how the notice cycle actually works, how installment agreements really function, and how to make sure future you doesn't relive this anxiety next year. We are not going to shame you. We are not going to scare you. We are going to look at the math, because math is manageable. Emotion spirals. Numbers stabilize. If you currently have an unopened IRS envelope on your kitchen counter, if you've been refreshing your bank account wondering how you're going to cover a tax bill, if you filed and immediately regretted hitting submit, this episode is your reset. Owing money is a financial transaction, not a verdict. Let's break down why it happens. Let's strip this down to numbers. You owe the IRS for one reason, because the amount of tax calculated on your return is greater than the amount you already paid in. That's it. There is no hidden moral algorithm. There is no secret character evaluation. It's subtraction. Total tax liability minus total payments and credits equals balance due. If that number is positive, you owe. If that number is negative, you get a refund. It's math. But the inputs to that math can shift in very normal ways. Let's walk through the most common reason business owners end up owing without judgment. First, income increased and estimates didn't keep up. This is the most common scenario I see. You projected your income in April. You made quarterly estimated payments based on that projection. Then business picked up. Quarter 3 was strong. Quarter 4 was stronger. Revenue increased, which is good, but your estimates were based on earlier numbers. So when the final return calculates actual profit, it shows more tax due than what you prepaid. That is not your responsibility. That is under projection. And projections are imperfect by nature. Second, withholding disappeared mid-year. Maybe you had a W-2 job in January through June. Taxes were being automatically withheld. Then you left, or you reduced your hours, or you transitioned fully into your own business. Now withholding stopped, but you didn't immediately adjust estimated payments to replace it. So your prepaid amount dropped without you realizing it. That's not negligence. That's a transition. Third, credits changed. Last year, you may have qualified for a credit. This year, you didn't. Maybe your income increased beyond the phase out. Maybe the credit expired. Maybe your circumstances changed. When credits disappear, your net tax increases, even if your income didn't change much. Fourth, one-time income events. A client paid a large invoice in December. You sold equipment, you received a distribution, you cashed out something you hadn't planned to. Those one-time events increase taxable income. sometimes in ways you didn't anticipate when making quarterly payments. Again, math outcome. Fifth, underpayment safe harbor misunderstood. There are safe harbor rules that can protect you from certain penalties if you paid in enough based on your prior tax year, but those rules do not eliminate tax owed. They only protect against additional underpayment penalties in certain circumstances. You can still owe tax and be completely within safe harbor. The balance due does not mean you violated a rule. It means your payments were lower than your final liability. Now let's address something subtle. Refund culture has trained us to associate no balance due with success. But refunds often mean overpayment, and overpayment means you gave the government an interest free loan. Now, some people prefer that because it feels safe, but technically speaking, a small balance due at filing, when plain and manageable, is not inherently bad. It means your estimates were close. The emotional issue arises when the balance is unexpected, and unexpected bills trigger stress. But unexpected does not mean unethical. It means forecasting missed, and forecasting is a skill that improves over time. Now, here's something important. Owing money does not automatically mean you underpaid recklessly. Sometimes it means you chose to keep more working capital in your business during the year instead of sending it in quarterly. Cash flow decisions matter. If you retain cash to cover payroll, invest in equipment, or stabilize operations and then pay the difference at filing, that's not irresponsible. That is liquidity management. Now, if you ignored estimated payments entirely for years, that's a different conversation. But if you made payments and simply fell short, that's math variance. There is a difference between avoidance and variance. Variance happens when you're trying. Avoidance is silence. And we're not talking about silence here. We're talking about the math of variance. Now let's talk about emotional distortion. When people see a balance due, they often assume I did something wrong. But the tax system is pay as you go. It requires prepayment based on estimates. Estimates are educated guesses. Even well-informed guesses can be off. So instead of asking, what did I do wrong? Ask, what changed in my income or payments? Because the answer is almost always there. Now let's take it one level deeper. Profit creates tax. That's the design. If your business made $100,000 in profit, there will be tax. That is not punishment, that is participation. Taxes are a percentage of profit. No profit, no income tax. Profit, income tax. It's linear. So sometimes owing is simply evidence that your business crossed into higher profit territory. That's not failure, that's growth. The key is planning for it next time. Now that we understand why it happens, let's talk about what not to do next. Because the mistake that creates real damage is not owing, it's not filing. And that's where things accelerate. Let's move into that next. Now let's talk about what happens next. You file your return, you see the balance due, and you think, I don't have this right now. Or worse, you don't file at all because you don't have the money. This is where fear tends to take over. So let's remove fear and replace it with procedure. The IRS operates on automation. It is a system. When you file a return that shows a balance due, the system records the liability. If payment is not received by the deadline, interest begins accruing automatically. Interest is not personal, it is statutory. It accrues daily based on federal rates. There is no emotional evaluation happening. It is math applied to a balance. In addition to interest, there may be a failure to pay penalty. This is generally much smaller than the failure to file a penalty, and this is where I want to be very clear. Not filing is dramatically worse than filing and not paying. If you file on time, even if you cannot pay in full, you avoid the larger failure to file penalty. That penalty can be up to 5% per month of unpaid tax. The failure to pay penalty is generally smaller, often around 0.5% per month. So filing protects you from the bigger problem. Silence creates the bigger problem. Now let's walk through the notice cycle calmly. If you file and do not pay, you will typically receive a notice. The first notice is not aggressive. It says something like, you have a balance due. It includes the amount of tax, penalty, and interest to date. It includes instructions for payment. It is informational. If you ignore that notice, the system continues. Additional notices may generate. Each one increases in urgency and in tone. Not in emotional judgment, but in clarity that the balance remains unpaid. If the balance remains unresolved for an extended period, the IRS may begin collection procedures. But here's the key word, may. And there's time between these steps. It's not instantaneous. The system does not jump from balance due to seizure overnight. There is structured progression, and at every stage, participation pauses escalation. When you respond, you interrupt automation. When you ignore, automation continues. That's the rule. Now let's talk about installment agreements, because this is where people often feel embarrassed. If you cannot pay in full, you can request a payment plan. This is not rare, it is extremely common. Millions of taxpayers use installment agreements. The IRS prefers structured payments over silence. When you enter into an installment agreement, you agree to make monthly payments. Interest continues to accrue. Penalties may continue at reduced rates. but active collection actions are generally paused while you remain compliant with the agreement. Again, procedural, not emotional. Now let's talk about something that surprises people. The IRS does not expect every taxpayer to pay in full immediately. They expect communication. If you file your return and set up a payment plan promptly, you are participating in the system. Participation reduces stress, avoidance increases it. Now I want to address something important. Collection actions like liens or levies do not happen because you owed $3,000 and were 10 days late. They happen after extended periods of non-response. And even then, there are notices and opportunities to respond. The worst move is pretending it will disappear, because it will not disappear. Interest is automatic. Automation does not feel, it calculates. So what is the most powerful thing you can do if you owe and cannot pay in full? File the return, open the notice, respond, set up a plan. That's it. Those 4 steps prevent escalation in the vast majority of ordinary balance due cases. Now let's zoom out emotionally. The envelope feels threatening, but the envelope is information. It is not a moral indictment. It is not a character assessment. It is a billing statement. If your electric company sends you a bill, you don't assume you failed at life. You assume you used electricity. The IRS notice is similar. You earned income, taxes calculated, a difference exists. That's the math. Now, can penalties and interest become expensive if ignored for years? Yes, but that's not what we're talking about here. We're talking about ordinary balance due situations that are handled through filing and communication, and those are manageable. Now let's talk about the bigger shift. Instead of asking, what happens if I owe? Ask, what happens if I engage? Engagement slows the machine. Avoidance feeds it. And once you understand that, the fear drops significantly. Now that we've walked through the system, let's talk about something even more important. How to make sure you don't feel this surprise again next year. Because the real power move is forward planning. Let's go there next. Now let's talk about the version of you 12 months from now, future you. Future you opens your tax software, or meets with your preparer, or reviews your draft return, and instead of a stomach drop, you feel neutral, prepared, maybe even calm. That outcome is not luck, it's structure. The goal is not to eliminate tax, the goal is to eliminate surprise. Surprise is what creates anxiety. Tax liability is predictable when income is predictable. So let's talk about how to reduce surprise. Step 1, know your effective tax rate. Not your marginal rate, not the headline bracket you saw on Google, your effective rate. Take your total tax liability from this year, divide it by your total taxable income. This gives you a percentage. For many small business owners, that number might land somewhere between 20 and 30%, depending on income level, filing status, and deductions. Once you know that number, you now have a forecasting tool. If your business makes $100,000 in profit next year and your effective rate is 25%, you can expect roughly $25,000 in federal income tax. Not exact, but close, and close is powerful. Step 2, pay quarterly, intentionally. The tax system is pay as you go. That means income earned throughout the year should generally be accompanied by tax payments throughout the year. Estimated tax payments are not punishment, they are prepayments. If you wait until April to address an entire year's tax liability, it feels heavy. If you spread it across 4 quarters, it feels manageable. Quarterly payments are due in April, June, September, and January. Mark those dates. Set reminders. Treat them like recurring obligations, not optional tasks. Step 3, create a tax holding account. This is one of the most powerful habits you can build. Open a separate savings account labeled tax. Every time the money hits your business account, transfer a percentage into that account. If your effective rate is 25%, transfer 25%. Do it immediately before you see the money as available. That way, when quarterly payments are due, the funds are already sitting there. And when you file your return, that balance due is either small or zero. Psychologically, this changes everything. You stop feeling like the IRS is taking money from you, and you start feeling like you were holding it temporarily. Step 4, review mid-year. Don't wait until December to see how the year went. In June or July, run your profit and loss statement. Compare actual profit to projected profit. If you're ahead, increase your quarterly estimates. If you're behind, adjust downward. Forecasting is dynamic. It improves with data. Step 5, understand cash flow versus profit. This is where confusion often happens. You can have cash in your account and still owe tax because tax is calculated on profit, not on remaining cash. If you spent aggressively on equipment, marketing, or growth initiatives, your cash may feel tight. But if those expenses were capitalized or structured in certain ways, taxable income may still be significant. Understanding that difference reduces shock. Cash flow tells you what's in the bank. Profit tells you what's taxable. They are related, but not identical. Step 6, don't confuse refund with success. Some people aim for large refunds because it feels safe, but a large refund usually means you overpaid throughout the year. That's not inherently wrong, but it's not required. The goal is alignment, not overpayment, not underpayment, alignment. Now I want to address something important. Planning is not about eliminating tax. It's about anticipating it. Taxes are a percentage of success. If your business grows, tax grows. That's not the system punishing you. That's the system functioning. The real failure is not owing. The real failure is being surprised repeatedly and refusing to adjust. And that's fixable. Now let's talk about something practical. If you owed this year and it felt painful, ask yourself, did I set money aside consistently? Did I just adjust when income increased? Did I understand my effective rate? If the answer is no, that's information, not shame. Information lets you correct. Shame freezes you. Future you does not need perfection. Future you needs a process, a percentage, a savings account, quarterly reminders, mid-year review. That's it. And when you build those habits, tax season shifts from panic to reconciliation, because reconciliation is predictable when inputs are tracked. Now let's bring this home, because owing is not the villain. Avoidance is. Let's reset the narrative one more time. Owing the IRS money is not a verdict. It is not proof that you are irresponsible. It is not proof that you are bad at business. It is the result of a calculation. Income came in, payments went out, a difference remained. That's it. Now, can that difference become expensive if ignored? Yes, but that's not because the system is emotional. It's because the system is automated. Interest accrues, notices generate. The machine continues moving. Your power is not in stopping the machine. Your power is in participating in it. File the return, open the notice, set up the payment plan, adjust your quarterly estimates, and move forward. Participation stabilizes the process. Avoidance escalates it. And here's something I want you to hear clearly. There are millions of taxpayers who owe each year. Millions. Business owners, U2 employees, independent contractors, high-income earners, growing startups. Owing is not rare. It is ordinary. What separates calm from chaos is response. Now let's zoom out even further. If you owed because your business was profitable, that is not failure. That is growth. Growth comes with new responsibilities. Higher profit means higher tax. That is the design. We do not shame profit. We plan for its consequences, and planning reduces anxiety. The moment you understand your effective rate, the moment you start transferring a percentage into a tax savings account, the moment you review your numbers mid-year instead of April, you shift from reactive to proactive. And that shift is powerful. You start expecting the reconciliation. Now, I want to address one more emotional layer. Some of you may be carrying guilt right now. Maybe you didn't make estimates. Maybe you ignored a notice. Maybe you've been avoiding the login screen. Here's the truth. The IRS does not punish honesty. It punishes silence. If you engage, even late, you regain control. If you respond, you interrupt escalation. If you set up a plan, you move forward. There is no award for pretending it isn't there. There is relief in facing it. And that relief starts with understanding that this is math, not morality. So if you owe right now, take a breath. Look at the number, understand how it was calculated, and choose your next step. Participation is power, and power reduces fear. Next week, we're going to talk about something that pairs perfectly with this episode. Until then, know your rate, pay quarterly, separate your tax savings, and remember, owing is math, participation is strategy, and strategy is what makes your business stable. I'm Lauren Twitchell, and this is the Zero Fluff Books podcast. We'll talk again soon.